of the day is formed either at 3:45 or 9:45. Those trades are a lock because the dealer is faking right at the open of the session. No, I've been hanging around with you guys all night, Russ. Because I haven't, it's on there, but I haven't talked about it yet. The pattern can be confusing on the straightaway trades. How do you make sure of the direction? TDI will help guide you in that. I'll talk about it. Yeah, I'll talk about the safety trade. All right.
Just starting.
Okay. Here's what we're going to do. I'm looking at the questions, and some of it's about stuff I'm going to teach tonight. Yeah, I have a little sore throat. Sorry about that. It'll clear up. Don't worry. And I'll be fine. No, Scott, you won't be lost today, but you should review the recording and just do the best you can to get caught up. All right, let's look at the answers of this test. All right, hold your questions till the break. I'll take more questions at the end at the break, okay? All right. A lot of you sent me this. That's great. Just go over it briefly to walk you through it, then I'll put the actual answer key up. Okay, first thing you should look at, day tracer. You know where you are. Okay, this is the position of yesterday's high. Okay, the dealer is working the agent accumulation range. At 1 o'clock, what is the range? 1 a.m. Eastern Time, the range is 36 pips. Is that a good box? Yes. What do we anticipate now? The trend is up because market makers are trading above the moving averages and above the mayonnaise. That means on the 1 hour chart, price is trading above the balance line, which is the 50 EMA. All right, and I'll talk about it more. What do we anticipate the dealer to do? We anticipate the dealer to break below the Asian numbers. Okay, break below the Asian numbers in an aggressive move as a false move. Put in the first leg, pull back, hit the stops of anybody that's shorted in here, and make them think that long is the direction. When they change directions, gradually pull back and hit the stops of anybody that went long, and induce them to change their mind and continue short or stay short, and also to make them think that the continuation this way is warranted. Okay? Then in 1 bar, shift away from those traders. Go into consolidation, hit the stops, hit the stops, hit the stops, hit the stops, and then rise out of there. Hit the stops, rise, hit the stops high and start to trap, and then correct back into the range. I want you to notice that when the dealer is hitting the stops, imagine that hand picture I showed you yesterday, reaching down there and grabbing up the money and moving back. Okay, sound check real quick. Some people say they can't hear me. Yep, okay. All right, it's you. I know you can't hear me, but it's you. All right. And on to have Cliff, did you get my email? I didn't hear back from you, buddy. If you're in here. All right, anyway. Okay, we're good, right? All right, I want you to notice that when the dealer starts working aside, the pins, whatever you want to call them, the pins on the candle, the wicks, will be in the direction of the traps. When you notice at the low of the day, they will start pushing the pins to the downside. In the range, the pins will be both directions. And then on the top side, the pins will be to the high. Okay? This is on purpose. He's trying to deliberately induce traders. Right? What does a pin mean? Let's stop and analyze what a pin means. Candle was solid red at one time, pushing down, and then he pulls it back. Red pushing down, went back up, and closed green. Hit the stops drop. Push down there aggressively, and then open and pull away from it. It's always about trapping the money and showing traders that trade on faster time frames things to make them take the wrong directional move. Okay? Let me put the actual answer key, and I'd like you to take your Snagit with that. Let me blow it up for you. Okay? Let me see if I can scale it back a little bit. No, it jumps in increments. All right, take a screenshot of that, and that gives you everything. The shark fin, blood in the water, I haven't covered the TDI yet, so I don't want to talk about it. But it's coming. Okay? Everybody have this. Okay, you guys got it. All right. Next one. Let's look at this one. I don't have an answer key for this one, but we'll do it together. Okay, what do you have? Let's look at it. Let's grab a pencil. Okay, where are you in the cycle? Here's 5 o'clock. I know exactly where I am. Okay, the dealer has worked the accumulation phase. What is the range? Too small? All right, hold on. Nope, that ain't going to work. All right, is that better? Okay, cool. All right, here we go. 5 o'clock, the dealer's working the range. 1 a.m., what's the range? Okay? The dealer rocks back and forth, slightly below the Asian number to pick up some pendings perhaps, slightly above the previous Asian, pick up the pendings, right? Back and forth. What does the dealer do next? He aggressively extends, he vectors to the high, 4-hour moving average. Yesterday's blue tracer, which means what? Yesterday's high of the day. He railroad tracks up and down, pulls back. Again, what does he do? Induces traders to go long. In here, pulls it back away from them to trigger the stops of any stop losses that are here. Goes back towards the high. Remember these pins, this was all the way up here. And I want to tell you a neat little trick that the dealer does is he opens the spread. He widens the spread. That is also a clue. If you don't have a fixed spread dealer and can see it, it's a clue that the dealer is working the high. Okay, let's look at it in theory, and then I'll show you what's going on. Let me get a clean piece of paper here. I won't save it. I'll come back. All right, here's a clean piece of paper. Here's what the dealer is doing. All right, look. Here's your box. Chops back and forth, right? 1 o'clock, what's the range? We expect the range to be less than 50 pips. Less than 50, and you know I can't write, so with the mouse, it's terrible. It's less than so, close enough, all right? 1 a.m., the range is less than so. The dealer widens the swing, and he breaks in 3 aggressive moves to the high, right? We'll talk about the speed and power and how many pips these moves are. But for now, it's 3 moves. 3 swipes at the high. 1, 2, and the third one is a little tap usually. Okay, but it varies. Now, here's what happens. The dealer works up to the blue tracer. The blue tracer is yesterday's high or yesterday's low, and we're going to cover that in detail. I'll break all the chart elements down for you probably tomorrow or whenever it comes up in the slides. All right, now here's what happens. There are pending orders sitting above that blue tracer. Okay, so let me bring this segment down over here so we can see it. Here's the blue tracer. This is like an inset shot. All right, that's the structure we're looking at, and here's the blow up of it. All right, the dealer came in here. Right, there's your 3 pushes to the high. Now, here's what happens. When he gets to the high of the day, the spread will open like a whip and come back together. Okay, you know that when you look at the dealer and you put up your little tick screen and MT4, you have a blue and a red line, and it stays constant at around 2 pips. When the dealer gets to the high, he opens the bid and ask. He doesn't want to see the bid go up there because that means people that are on that side of the trade will be in profit. So he whips it open, and he grabs those orders from the traders. He might open it 5, 7, 10 pips, and then he will bring it back together and calm it down back into 2. Let's say that this is euro and the spread is 2 pips, right? So it goes up there as 2 pips. It gets to the high. The dealer expands the spread to catch all the orders that are sitting here, but not allowing this side to see a profit, because if he brings it up within a 2-pip range, the scalpers will get out with +2 or +3, or anybody that is trying to see a profit will see a small profit. So he opens the bid and ask, whips it over the top, absorbs the orders, and then brings it back together and calms it down at 2. And that will give you an understanding that the move is starting to reverse. Inside of this open spread structure, let me clean it up a little bit. Inside of this open spread structure, the candles will be doing this. And then start to correct, right? First leg, the dealer comes near the high, opens the spread, goes back towards that high, does not violate the high, or pins above the high and comes back below in the form of a hammer. Okay? Now, how long? Nothing has changed. 30 to 90 minutes. The dealer works this area 30 to 90 minutes, but he will open the spread. 30 to 90 minutes is up here. He will open the spread when this particular candle is right at the high. The spread will open. It might come back in and then open back up and look like, almost the spread will look like an M itself. That's why scalpers can't book. That's why traders that are trying to grab 2 or 3 pips can't book a profit. Because the dealer will hold the bid and open the ask above the pendings, absorb those orders into his float, and not allow the bottom side to book. Okay, that the spread is another edge against traders to beat them. They use this excuse in news where the spread can be 25, 30 pips apart or greater. I've seen it very, very ridiculously high sometimes, 75, 80 pip spread, and you can't get filled. And it says right on there on page 27 of the crap you signed when you open up at the dealer that fast-moving markets warrant big spreads, and if we can't guarantee the price, blah, 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 that means they could pretty much screw you. That's what it means. That's a con for them to take your money, basically. Okay? So look, understand that as part of this structure, the dealer is opening the spread, and he will bring it back together when the work is done and it calms down. It may open and stay open, or it may open, and as price pulls back, it'll pull back. But that's a clue that you are in the right segment of the market, that you are at the actual high of the day. Is that the dealer is working the spread to absorb the orders for his book, but not allowing traders to book a profit that are on the right side of that. Okay. All right, back to this chart. And yes, I will blow it up again. Okay, so now the dealer will widen the spread and go above. So right here, when these railroad tracks go to the high, he will open the spread above the blue tracer, and in essence form an M with the spread. Okay? Allowing himself to get these orders that are above yesterday's high is another edge for him to grab the orders and reel them in. Then what happens is it closes on a hammer, which is the dealer goes back towards the high. Remember, this was solid green at one time. This candle went all the way up, solid green came all the way back down, and ended as a hammer. A hammer is a very good clue that the dealer has triggered the stops and induced traders to go the wrong way and will correct off of that price point. Something really cool about a hammer is that the hammer is usually the last bar before a shift bar. Okay? I'll say it again because it's important. The hammer is usually the last opportunity before the dealer shifts the zone. Because in essence, what he's doing is in 30 minutes, he's moving the zone away from higher level long holds. Okay, here. Right? Would you agree that it is a fact that these two bars equal 30 minutes? Okay, so what has he done here? He has ran up probably in the first 10 to 12 minutes of the candle, and within 2 to 3 minutes to go, he has reversed it out, closed on a hammer, opened, and corrected big against that. So in 30 minutes, he has come below the high and cleared the board in here of all the traders that took longs or shorts, hit their stops, and correct against those traders. That's what's going on here. Okay, look at it again. It's important stuff, okay? The dealer vectors to the high. He grabs it. He opens the spread. He pulls back. He goes back towards the high, and he comes below that high aggressively in 30 minutes, shifts the zone away from higher level longs, and cleans out the area in one swipe. Then he stutters back, hit the stops, see the pins, hit the stops, and drop. Hit the stops, induce, hit the stops, and drop. Hammer to the downside, correct back in, second leg. How do you know that's a second leg? It closes above the first low of the day, the first setting of the low of the day. After a big area of consolidation, and we're into the new session. Okay? Let's look at it again. Session changeover is in here. The dealer opens the session with a spike to the low to induce traders. This hammer was all the way down here at one time. It closes on a hammer. The dealer goes back to the middle of the range, and then the rest of the day drifts and puts in the second leg, and there is another hammer right there. All right, did you guys get this on the chart? Did you see all this stuff? If not, mark it up the way we went over it. Okay? I'll go through it really fast. Okay, so the entry triggers are dealer trading above, name the entry triggers. The entry triggers are dealer trading above the 4-hour. This blue line is the 4-hour line. Okay? Dealer trading right to yesterday's high and not violating that high, opening the spread to grab the orders. Asian range, 30 pips at 1 a.m. Dealer vectors aggressively to the high, issues a hammer on the second leg, shifts the zone away from higher level long holders, hit the stops, drop. We're good to go. We got it today. Okay? The dealer approaches the session changeover. He appears to stall, but he's trapping top side. He takes those traders and spikes them. He issues a hammer into the session and reverses off that number. ADR is just missed. That's the orange ADR marker. We just missed ADR. But if you notice, here's yesterday's low. Okay? Very important to look at that. Yesterday's low. Let me clean up the chart a little bit. All right. Yesterday's low. Comes in from yesterday. Look at this hammer. Close below it. A break plus a close is a sell in the retail world. He pushes below it, and look where he closes, right on it. And then he pulls away, and there's your aggressive stop hunt. Anybody that was short is now out and out of business for the day. Okay? The dealer works right to it, right below it, and back above it. Very important to note those. Why? There is a huge amount of traders that place pending orders above and below yesterday's high and low. That's why we track it. And it's denoted by the blue tracer. It says day high, day low. But it should say Y day high, Y day low. And maybe I'll get that changed one of these days for you guys. It's yesterday's high and yesterday's low. You have to understand that the orders are placed there as a system or method, and the dealers know this, and they work the crap out of those numbers and punish people. This would be a range day because the dealer traded within the confines of yesterday's high and low, right? Perhaps level 3. He had everybody come into level 3, and then he worked level 3 for one more day, and to jam them up, right? When the market has a big rise, it needs more guys. When the market extends the low, it's time to go. The chop denotes that you are impossible level 3, and the reversal is imminent. So if the dealer stays within the confines of the blue lines from yesterday, you are probably at level 3, and he is working that to entice people to come back into the market, so it's worth the money to move it. It costs money to move the market, right? It's not a free ride for the dealer. He has to flash that with his volume. He has to buy or sell and create a move. So in order to create the move, he has to say, all right, here's 500 million. I'll throw that out there and see which way it goes. Okay, he threw 500 million out there. He flashed euro up for the day, and people bit and bought into it. All right, I got what I was seeking. I threw a $500 million order out there, and everybody bid it up plus some. Now I'm 700 million long. I'm holding 700 million short. The market's 700 million long. I can correct against that and work it. But I don't want to release. Remember the hand. I don't want to release my greediness over here. Okay, this is my rendition of a hand. I should just use the pictures, right? I need like one of those back scratchers and take a picture of it, and I can grab the charts with it. Look, that's what he's doing. They're grabbing on both sides because they already have volume trapped from yesterday, and they're hitting some stops along the way and seeing where they're at with it all. Now they're analyzing their book, and they're going to make their decision whether to continue the correction or rise against those traders based on the open volume that they have of net longs and net shorts. That's it. Okay? I'm going to take a sip of Diet Coke. Hold on. All right, I hope you can't hear that. I tried to put my hand over the mic, but if you can, I'm sorry. All right, so hopefully this helped you, but the entry triggers are above the 4-hour to the blue trace, the railroad tracks to the high, second leg hammer. Dealer worked it for how long? Let's count. How long did the dealer work it, anybody? Dealer hit the high here, bar 1. We don't count that, but let's say that's bar 0 because that's when the high is formed. So 1, 2, 3, 4, 5, 6. Dealer worked it for how long? Where I come from, that's 90 minutes. 6 15-minute bars is 90 minutes. Okay? The dealer worked in the area of the high, 90 minutes. Okay? So what does that tell you? 90 minutes. Man, you could do a lot in 90 minutes. You could run a marathon. You could work out at the gym. You can go through 2 cycles on the circuits. You could do a lot in 90 minutes. That should offer you a peace and a calmness about the business. The dealer works the area for 30 to 90 minutes. 90 minutes being ideal. Usually about 4 bars, about 1 hour. 60 to 90 minutes. So you can make a decision to yourself mentally right now. You know what? I'm not taking on any of the 30-minute bullshit that the dealer throws at me. I'm going to wait for the 60 to 90-minute setups where I can approach the market with calmness and precision and pick these guys off like a surgeon. I can extract my money like a dentist extracts a tooth. Put the patient under and steal his money. No. What I'm saying is that you can approach it with a calmness. There's no hurry up, I'm missing it crap. That's garbage. If you know the dealer is going to hold the level for 60, 90 minutes, up to 2 hours, and hang around that level, what's the hurry? You approach the market methodically and calm, and you see the dealer get to the areas on the chart, okay? And when he gets to the area, you simply draw yourself a line. There's my high of the day. Okay, if you drew it here, it was violated, that's fine. But you're looking for this type of structure where the dealer works, pulls back, goes back up there, ends in a hammer, and it is lights out. You can enter here or here. Either one's acceptable. I like to see people enter before they shift the zone, and here's the reason why. If you can learn to enter before they shift the zone on you, you're going to be able to add on the lots because your stop pips, 13 pips, 15 pips, 17 pips. That's going to be your stop loss. Why can it be so tight? I'll talk about stop losses when I get to the slides, but the stop loss in this trade goes above the second leg, slightly above the second leg. So if you entered here and your stop loss is right above the second leg, why second leg? Because most of the time the dealer will not come back a third time. And if he does and he grabs your stop, so what? Take him again. And I'll talk about how to handle your stops and manage that. We're going to talk about it. Stop loss goes outside the reach of the dealer. The dealer is not going to move a $4 trillion market back to get Ray or to take out Joe Shaw. He doesn't care that Jim Seeley is short with the right setup. All right? Okay, I hope you guys are seeing this stuff. We're gonna do a lot of charts. Have a lot of charts for you coming up. The only way to see it. There's a saying I always say, and I'm going to say it. If you can't see it in hindsight, you're never going to see it in foresight. You can't see it after it's developed. How the hell do you expect to see it when it's developing in real time, right? All right, today, some good stuff. We are going to talk about the levels. Okay, so I want to make sure everybody's with me now. You're okay. You got the answers on the chart. I don't want to leave anybody behind because we're building. So now here's what you have since you met me. All right, I'm going to give you the whole class in 2 minutes. The pattern, the pattern, the pattern. That's the whole class. Now it's breaking that pattern down and understanding how to read the market maker's intentions on the chart, what he's up to and what he's doing. Okay, we do that through using levels, where he's at in the dealer's trend cycle. And we do that by understanding what his next move is. We are reactionary. I've said this before, but I'm going to tell you. Have you guys ever heard the song? I think Ludacris sings it. It's a rap song, and it just sticks in my head. It's when I move, you move, just like that. When I move, you move, okay? So that means, I know I can't sing. I need to stick to trading, right? But the point of that is that you are reactionary to dealer behavior. Dealer breaks high out of London at 1 a.m., you're a seller. Your reaction is, the dealer has showed me something on the chart, okay, that I can work with. He has given me a break high. A break high is not a buying opportunity unless you're in straightaway territory. A break high is usually a vector to form the high of the day. We can anticipate the structure we just worked on and a correction back into the range. Okay? The dealer breaks low. I can work with that. I can work with a break low. I'm looking for the low of the day to set in and trade away or in line with that W formation. Okay? That's what you're looking for. It means being reactionary and a calm, methodical approach to the dealer's behavior. You don't see this and go crazy. Hurry up, we're missing it, get on. And there's a guy that used to do that. I bust his chops, but he's a great guy. I love him. But when I met him, in the first day of my class, Australian USD made a spike to the high, and he screamed, "Look at that 100-pip spike, we're missing it," in the back of the room. I'm not kidding. I don't know if he's in here or not. If you are, brother, I love you. And I was like, the whole class was there, and I said, that's exactly what they want you to do, so don't do it. Those vector candles and spike moves are designed to get you emotional and make you feel like you're missing something. When you see that crap on the chart, you should just go, man, they just got a bunch of suckers to bite on that. That's the approach, a calm, methodical approach. When the dealer breaks high, you relax, and you wait for the high of the day to settle in, the low of the day to settle in, and you trade away from that in line with the dealer, opposite of the retailer mentality. That's the business. Now, in order to anticipate the dealer's moves, we examined a thing called levels, and we're going to do that lesson now. Okay, clean off my slides, and I actually have another slideshow for that. Let's see, it is, man, the pen's a mess. All right, sorry. Okay, here we go. I will make it regular. Okay, levels, levels, and some more levels. Let's talk about them. Okay, what are levels? They're based on trader psychology. Fear and greed and inexperience are used to prey upon the trader's emotions. Big candles, spikes, not understanding the direction or where the market's going to create the emotion. These are the things that the dealers have been doing to you by design since you've been in the business. Understand that there are intraday counts and counts over several days. So what do I mean? You count the levels intraday, 1, 2, 3, like I showed you yesterday. But also, as part of the weekly cycle that the dealer performs, those levels are in there. 3 levels of rise over 3 days, 2.5 to 3 days, or can extend it out to 4 or 5 days. But these are all trap moves to grab your equity and to keep you confused about which way the market is going. Understanding the count or what level you are in will virtually eliminate all your technical analysis study time. You don't have to go back anymore and draw support and resistance lines on a chart all the way back from 1902 or the 1600s and drag in a support line and go, oh, this is a great support line back from 1530. I think it's going to hold. You don't have to do that anymore. It's a waste of time. Since people trade those lines, the dealer will interact with those lines, but you simply identify the signal that he issues and understand his behavior at that line. If there's a support line on a chart, okay, from 1977, it was the highest euro's ever been. Let's say support, the lowest euro's ever been since 1977. I don't know, whatever. I'm just pulling stuff out of my butt, okay? 1977, there was a support line. Okay, now, do you need to worry about that? No, you need to see what the dealer does at that line, which means the pattern and the structure that I've been teaching you for the last 12 hours, or I don't know how long has it been, 24 hours that we've been talking about, is he's still going to do this no matter what support and resistance is anywhere on any chart. The dealer is going to do this. Go down to it and react on it. Okay? He's going to go down to it. He's going to go down to it, trade below it, work it below, and then come back above. Those are the options. So if you know this is coming, what do you give a crap about 1977 support and resistance and drag them onto your chart? And, oh, I have all the charts and support and resistance marks since I started trading in 2000. I know every price point. Yeah, well, guess what? I know they don't hold because I know the dealer works them based on the volume on either side and his open float and his behavior at those points, which is simply a W or an M pattern after he vectors and comes out and behaves a certain way, or he might make an outside structure. That's how I understand where I am in the cycle. If the dealer makes a 50 pip range and vectors down to some imaginary line, I could care less. I'm trading a pattern. I'm trading a behavior, a footprint by the dealer that's an absorption of contracts and money that's visible on the chart for me to react off of. Reactionary to the dealer's move. When I move, you move. Okay? When the dealer moves, I make my move. When the dealer shows me something, I react to what he's showing me. When I move, you move. Just like that. All right. Do not associate counting the levels with anything else. No other indicators, no other garbage, no Elliott wave counts. None of that stuff. The levels are based on trader psychology, and they are based off of the number 3. Everything that the dealers do is based off of human psychology and the number 3. You got to realize this is a $4 trillion a day open float business. You think they don't have the resources to study human behavior? You think they don't have psychologists on the payroll? You think they don't know what people are trading out there? Man, they have complete transparency. They see everything on every platform, and they know what everybody's doing. There's a lot of money at stake here. You think they're just going, oh, I hope poor Tread figures out this breakout system, and if he does, we'll let him make a few pips. That is not what's going on here. They are setting these traps every single day and acting against these patterns and acting against these technical studies that people do and lining their pockets. There is no way they would be this wealthy if it was a fair and just market. But now I'm showing you how to step from the 90% over to the 10% of being successful in reading what these guys are doing and trade your account like a market maker. That's the only chance you have in this business, is to trade your account like a market maker. Okay, so market makers form zones or levels to trap the traders, book profits, and hit the stops. Sometimes it will be very easy to identify, but remember that at level 3, you will always see aggressive moves. Level 3 behavior is what traders that can't explain it call risk appetite. Level 3 is an aggressive move to chop the market, hit the stops in both directions, induce traders to take positions so the dealer can balance his book and make money. That is what people say, oh, risk appetiters entered the market. No, probably in level 3 if that statement comes out of someone's mouth. Okay? Can the dealer see your MT4 platform or just open trades and stops? The dealer can see everyone's individual platform, but he is not dealing with your individual platform per se, unless you have a super large account. The dealer is making the behaviors based on where the orders lie in the market. And because everyone studies the same technical crap, the orders are about the same spot for everyone. Think about it. Death cross or golden cross. 50 crosses at 200, what does everybody do? Long. Signal lines cross the 50 move EMA. What do people do? Long, short, depending on which way it crosses, right? Okay, so as a general rule, people see these technical studies. What do? MACD's above its 0 line, moving averages crossed on the chart. To the upside, I buy. Okay, well, since people have read those technical studies, what happens is that a collective group of orders of open float is at those price points, and the dealer can see that and acts accordingly to those levels. Now, it may seem like, man, that dealer's killing my account. He's specifically after me. No, it's just that people are taking those setups as gospel, and when they trade them, it's a collective group that opens orders at those prices. That's what's going on. That's the reality. So that's why you feel like the dealer is mauling you individually or singling out Scott and going, look, Scott, I'm coming in to get you, man. That's not what's happening. What's happening is that you've done the technical studies, you've done your homework, you're trading a system that has been around for eons. The dealers are completely aware of why people what they do and why they behave at those areas, and they act accordingly. Some days they let you in to build more book, and when they have what they need, they correct against those moves or act against those moves and book a profit. All right. There are 3 levels of correction or rise. This is how the market is structured. We're talking about intraday structure and longer-term structure. Because the pattern is fractal in nature, it shows up in small legs during the intraday cycle, within a 24-hour cycle, and within a 5 to 7 day cycle, the week. Okay? The first level of correction or rise is market maker driven. That's where the fast moves come from. It's from a flash of volume. Okay? The second level of correction or rise is market driven in absence of market maker support. That's when the emotional traders, I can't believe I'm missing it, guys, come to the table. Okay, think about it for a second. The dealer, first level, flashes his equity into euro and creates a vector candle to the high. He steps back and likes to see what happens. Some amount of traders buy, some amount sell, and he lets those orders come in and he fills those orders. The third level of correction or rise is market maker driven. It's to trigger the stops, create more panic, and induce traders to continue with the wrong directional move. During the levels, market makers will buy from the traders to create positions, and whether they buy or sell, they're taking up the other side of the order. They're buying. With the heaviest volume being seen at level 3. That's where the risk appetite is, the chop in the market, the things that people talk about. And if you don't know what risk appetite is, don't worry yourself with it. It's garbage. It's confusing. But it's an explanation that people use that don't understand what's truly going on behind the scenes. Okay? Level 3, most aggressive. And understand that in level 3, you will see multi-session M's and W's, 22 trades, 33 trades setting up, and you will see the head and shoulders pattern. Okay. In addition to each of the 3 levels, there is a corresponding level of consolidation. Most of the time, the stops will be triggered before the next level is started, but during these zones, 20 to 30 pip swings will be seen. Okay, that's when people panic and get out. It's by design. The market makers are trying to hit the stops both ways to make easy work of the next level. They release the buying or selling pressure from the market and can move to the next price point on lower volume because they've cleared the board, so to speak. Okay, so now let's look at this little sketch. No, that's not the sketch. This little sketch. All right? Here's what happens. You have a small range, less than so, 50. Looks like a 5 this time, right? Here's what happens. You take up a position right here. The dealer comes out and consolidates. And what does he do? He swings right here, hit the stops, and he brings it in. And almost forms like a smaller wedge type pattern. But what he's doing is he hits the stops, bring it in, analyze, break to the next level. During the time when he swings this will be 20 to 30 pips in range. Okay? Sometimes he does it right off of the entry. So if he makes a lower stop hunt of only 25 pips and he shifts the zone and he goes into consolidation right here to hit the stops, you're going to feel like when he comes back towards you that you should choke yourself out of the trade because, oh my gosh, it's coming back on me. And a lot of people do that and accept the smaller number. What the dealer is doing is he shifted the zone and he's analyzing his book, but it just so happens to be closer to your entry than normal because the stop hunt was mild. Okay, a 50, 60 pip stop hunt, he'll shift off 25, 30 pips and then make a 25 or 20 to 30 pip swing. If he comes back on you, you're not going to be like, oh, I'm almost out. How many times have you been up 6, 7, 8, 10 pips, and it comes back to +1, -1, +2? This is the reason why. Because the dealer has gone into first level consolidation off of the peak to analyze what he's got, hit the stops, and release the pressure to move to the next level clean. Okay, so ask yourself how many times the dealer has done this to you and you've clicked out of stuff that was otherwise good because you were like, oh, it's coming back on me, it's coming back on me, not understanding the structure. Okay? All right, lost my slide for a second. I'm sorry. Let's get back here. All right, that's where I was. Here. Okay, intraday levels. Let's do levels. We're going to do levels by the numbers. I'm going to get a sip of Diet Coke. Okay. If you want to figure out the projections and where the dealer will go based on simply by the numbers, a lot of people help them clear it up. You take the ADR of the pair being traded and you divide it by 3. Okay, since I'm terrible in math, we'll use some simple examples. But here's what I want you to do. Identify the high and low of the day. Identify the clearing of the consolidation, the dealer work, the 30 to 90 minute M and W and half Batman and outside structures, things that the dealer does. And then start counting from this point. Add or subtract the ADR division points, or add or subtract at the end of day, and you can project by the numbers, right? I know that sounds like a mouthful, but let's do it. Let me show you what I'm talking about. Okay? All right. For simplification, we have ADR equals 100. There are 3 levels of rise or fall. I will divide each segment or each ADR by 3 for an intraday calculation. Okay? Now, I will take the dealer work, 30 to 90 minutes, stop hunt low. I know this is 30 to 90 minutes. I will take the dealer work, and I will look for the low point on the work. Let's say right here. Okay, now, I can anticipate projecting from here to here will be 33 pips. And the dealer will go into level 1 consolidation. I can anticipate hitting the stops, and rise another 33 pips and go into level 2 consolidation. I can anticipate that he will again rise 33 more pips and go into level 3 topside consolidation, and then I can take ADR, okay, ADR divided by 3 minus topside. All right, so now I take 33 pips and I project from here back down to mid-level consolidation. Right? 1/3 of the move back down. So if I have 33 pips to work with, I'm just oversimplifying, okay? I can anticipate roughly where the dealer will start, finish, and how he will terminate the move for the end of the day. I mentioned to you that the dealer trades 25 to 50 pips off of the high or off of the low to trap the traders and go into consolidation. Some days they're more aggressive and he goes back to mid-level in here, same as the Asian numbers. But if you notice as a projection, he's usually closer to the move that he finishes on. He's closer to the high in this example, but he'll be closer to the low if he finishes near the low. And that can be ADR divided by 3 and subtract that number from the top side or add it to the bottom side to give you those consolidations. Okay, you guys with me so far? So now, if I can take the ADR and anticipate where the dealer is going to make his moves, I should be more comfortable in that behavior and know that it's coming and not be afraid. Okay? ADR was 120 divided by 3. The actual move was 126. The projected ADR was 6 pips off, divided by 3. 120 divided by 3 is about 40. I had a 41 pip move. I had a 45 pip move. I had a 40 pip move. And then the dealer reversed back into mid-range. okay? And I would take low plus 40 and anticipate where he will terminate the trend in here into consolidation. And by the way, I wanted to point something out. The range, look at that right there on the red box is 40 pips, but he moved a little more than 40 pips. You see it? Hopefully that cleared it up for you. So when you're in a trade and you find peak formation high of the day or HOD and the dealer does this and you're in something and he comes near it and he comes back, you don't go, oh my gosh, it's coming back on me, I got to click out. It's part of the business. It's part of the dealer work. Okay? Trap high, hit the stops, drop. Hit the stops, drop. Hit the stops to the downside, trigger, induce, and run back. ADR divided by 3 plus 1 in this example. That's how an ADR is broken down and calculated. And that's, we're going to talk about the weekly cycle, how to make the top side projections by the number, and hopefully clear it up for you so you understand how the dealer's working it. Okay? When you look at it like this by the numbers, if you're a numbers guy, you might find this truly amazing. I did. I thought it was great. But what I'm offering you is a calmness and a methodical approach to understanding the market by the numbers and what's really going on. The dealer doesn't look at candle patterns. He don't care about that stuff. He cares about the money. But what happens is, when he gets the money, this is his wake. This is what he leaves. Okay? He leaves this behind. These footprints behind are left by the dealer, inducing traders to take the wrong directional move. But understanding that the top side has been put in should let you know that this is garbage. Okay, the dealer comes back above and hits the stops and drops to the next level. He hits the stops again, pins both sides, and hits the next level, almost to the pip, to the penny. I was able to anticipate on a 120 pip ADR, I was wrong by 6 pips. And boy, was I mad. I'm kidding. If that pissed me off, I got mental problems. All right, look. Some of you want to take a picture of that. This is a good place for me to grab a break because we're going to move on to the weekly cycle. And it's 5 of the hour. I'm going to see if I can take something from my sinuses so I don't sound so raspy on you guys. I should have when I started, but I thought about it now. Okay? Top side and low side is low of the day, high of the day, right? The top side, take ADR and subtract or add, right? If we have ADR and it's completed, then we know that we have 1/3 of the move, 1/3 of the move left to go back into the range. And the dealer will end in here, right? Because the ranges overlap, right? The push overlaps to the next level, right? Because what does he do? He makes the complete level, goes into consolidation, hits the stops, drop. Go into consolidation, hit the stops, drop, change the stops to the downside, trigger those, and then 1 times ADR added to the LOD will give us an approximate end of day in here. And I bet where he fell off, I bet if you measure from here to here, it's pretty close to 40. A 1/3 move back into the range. Because they overlap, this appears to be middle. Because the ranges overlap. Someone had an aha moment. Congratulations. That's the whole point of the class. Should be full of aha moments. But this exercise or seeing this should help you to understand. I'm breaking it down for you as what the dealer's doing each time there's a move. So when you're in something and you're up 16, 17 pips and it goes back down to +2 or 3, and you know that you got absolute zero on top side, you know this is absolute zero. You're 100% right because of the structure and where you are in the cycle. When he comes back, if you got in here and he comes back here and doesn't violate the high of the day, you know that the trade is still good. There's no reason to panic. There's no reason to click out and go, oh man, I can't believe it. I'm only up 3. I'm clicking out right now. I don't want to have a losing day. And I know everyone has illustrated that behavior in their trades. I know they have. So now, and if you look at something, and let me clear this picture up again. If you look at something kind of neat, in this example right here, this is a mini pattern. There's the box. There's hit the stops, high, drop. Isn't that little pattern this? Okay, so what's going on is fractal, not fractal. I don't really know the proper terminology, so I don't want to comment on fractal, but that's a baby hit the stops, high, drop consolidation pattern that I drew for you in the sales presentation. But understanding how the dealer makes those moves and ties those small patterns into the bigger picture and then the weekly picture should help you understand that when he makes a pullback against me, 20 to 30 pips, there's absolutely no reason to panic as long as I assessed absolute zero correctly, which is the high of the day, or absolute zero low of the day, the last number where the dealer said he had enough for the high. And in essence, you've identified true dealer support and resistance. The high of the day, where the dealer prints a number on the chart at 29.59 at the high, that is the absolute highest and best resistance there is. And if the dealer hits 28.38 as absolute low, then that is the best support that there is. Because the dealer says, no mas, not another pip today. Your stop loss could be 29.60, and it will not. I'm not telling you to trade with a one pip stop. I'm going to cover that. But I'm telling you that if you have a one pip stop at 29.60 and the high of the day was 29.59 and the dealer faded that number, you're gold, baby. He ain't taking you out today. Now think about this. What would a 1, 5, 7 pip stop do to your risk to reward ratio? Because you could take 10 lots with a 7 pip stop. And if you're right for 50 on the 10 lots, that's $5,000. If you're wrong, $700. Where I come from, that's a hell of a risk to reward ratio. Okay. I'm going to break here and we'll talk about the daily cycle. It is 7 o'clock. I don't know if I downloaded that stupid clock yet. I'll get it for you guys. And I'll put it up there. Let's take a 10-minute bathroom break. I'm going to try to find something for my sinuses in the medicine cabinet. We'll go from there. All right, go ahead, take a break. I'll put the clock up right now, and I'll see you guys back here in 10. Thank you. All right, I'm back. Everybody hear me okay? Hopefully over the next few hours I'll get better. Okay. All right, so any questions about everything that we're doing to where we are right now, since yesterday till now? Any questions? Any stuff has come up? A lot of you having little moments today, and I'm really proud of that. Some of you writing had some aha moments, more than one person. Glad to hear it. I know, listen, I always try to present the material in a more clear and concise manner. Took a year, sorry. And I'll accept blame for that because I'm trying to convey the information as clear as possible. And that's why I always go back and change the slides. This is the best one I've ever done. Well, I'd like to think that, but I'd like to think my best work isn't on the table yet. Joe is asking about how does the dealer take the loss. It's built into somebody losing, man. Okay. All right, let's move on. Let's talk about any other questions. Sorry. Ross, we'll talk about that later. I get more, better, and gooder. Thank you. All right. Okay, I want to clarify the levels a little bit. ADR is calculated from HOD to LOD. But since the dealer must work the levels, there's ambiguity. A level